Welcome back. And Amrita Sen is founder and director of research at Energy Aspects, and she joins us live here at CNBC TV18. Amrita, hi, thank you so much for joining us. The crude oil prices have been quite jittery. The latest, of course, has been a 3% decline in the overnight markets. But the latest trigger with Iran, Israel, the kind of profit taking that we've seen, and the fact that it has been a very strong, volatile year for the crude oil prices. How would you look at 90, which really seems to be a pivot point right now?
I think the biggest driver of crude oil prices this year has actually been fundamentals, right? We've seen a much stronger fundamental picture since the start of the year than anybody had expected. And in fact, if anything, prices have been lagging the physical prices that refiners would pay usually. And we've now actually seen a pickup in that. And then, of course, the latest is Israel, Iran, as you mentioned, and that has definitely helped Brent prices above $90. We maintain our view that we do not expect any supply disruption or any significant supply disruption for oil and gas from these geopolitical tensions. We also think, in general, neither side has an incentive to escalate it to the point of attacks, right, on either side, because I think that would be a lose-lose. But that doesn't mean that the tensions are going to go away anytime soon. And we also do believe the market will remain fairly choppy. We are not in the camp that expects significant upside due to the geopolitical tensions. It's more that it provides a bit of a floor, especially given fundamentals are already strong. So Brent should trade around the $90 mark.
So while you do believe that the prices will stay around 90 for this quarter and the next as well, what's your sense? Because there are various reports suggesting 95 and beyond.
We've been calling for, and our price forecast was for $85 Brent for the full year, very much from the start of the year. In fact, late last year, when most people I'm sure you talk to have had $60, $70 price forecast view, and we're not changing that yet. We've been calling for a $90, $95 Brent in Q3 in the summer. It's come a little bit earlier. So yes, there's potentially a little bit of upside, but the annual average should still very much be, let's call it 80s. Maybe it dips into the early 90s. Now, look, if the escalation were to get out of hand, could we see a triple-digit print? Yes, we could, but that's not our base case.
Amrita, there are various reports as well suggesting that a deficit is what we should be preparing ourselves for this quarter and the next, to the tune of 0.5 to 1 million barrels per day as well.
Well, for Q2, we have a very small draw, and we always have had that, but it's very June heavy. April, May are bills, which is why our core view has been we should be pulling back a little bit right now before we actually rally. The key thing for this oil market is what happens in the summer. It's Q3. Our balances are talking about 2.5, 2.6 million barrels per day of draws. This is an enormous draw, and stocks everywhere are actually quite low. So I think that's the challenge, and that's what the market is solving for. If you think about it, if we don't have a lot of inventories and we are heading into peak summer draws of over 2 million barrels per day, and our balances assume OPEC will bring back a little bit of production over the summer. In reality, they may not actually choose to bring back production. Is $90 enough to solve that, right? Is $90 enough to bring OPEC barrels back? Is $90 enough to incentivize the US administration to do an SPR release? It's not. And if that's the case, then prices ultimately will go even higher because the deficit is just too big.
Amrita, as you mentioned about the US and the SPDR draws as well, which we have seen immense, by the way, in the last couple of years. How are you looking at the US elections and the point that nobody would really want crude oil prices turning to those three-digit numbers?
Absolutely, which is why I just said, is $90 enough to elicit a response from them? We do think an SPR release is on the cards for this year. The US is probably going to draw down 30 million from their strategic reserves just to keep prices low. But that's probably not at 90. That's probably at $100, right? So we're still $10 away from that. But yeah, we do absolutely believe the US is going to turn a blind eye or continue to turn a blind eye towards Iran. Maybe they do not reimpose sanctions on Venezuela, which will actually benefit Indian refiners a lot. IOC, Reliance, they buy Venezuelan crude, and as of right now, the US needs to take a decision by the 18th, which is in 2 days, that whether they're going to reimpose some of the sanctions that they had lifted. And Indian buyers had actually stopped buying Venezuelan crude, but at $90 oil, maybe they don't bring that back. So look, they will do everything in their powers to make sure that prices don't go up too much. But at the end of the day, the fundamentals are strong enough that prices are not going to go down too much either.
Amrita, also, what's your sense on the Indian demand? I mean, I know the Chinese demand and the data seems to be improving, but much of the marginal increase in demand growth is expected to come out of India.
Indian demand is very strong for sure. I mean, it's a little bit mixed on the other oils like your bitumens and your asphalt demands. It has also been very hot. Diesel demand hasn't been particularly strong of late, but again, I think the heat wave potentially is a part of that. I think overall and more structurally, we remain very constructive on the gasoline side. More people driving, better roads and infrastructure, and of course, with elections coming up, generally there's going to be a lot of support for demand because again, there's just going to be more stimulus from the government. So robust demand of about 250,000 barrels per day, give or take, year-on-year growth, and this is about this is end user demand, gasoline, diesel, jet, and so on. And yeah, that should continue over the course of this year.
Amrita, there are various reports out there suggesting that the global aviation demand seems to be picking up, and those numbers are out, whether it's about Asia, US, or even Europe for that matter. What are the numbers that you're working with?
For globally, yes, jet is the biggest driver of global demand growth at about half of our 1.4 million barrels per day total demand growth. So more than 50% is going to come from jet because China's reopening is still ongoing from the airline side of things. Everything else is pretty much back to normal, but travel is still being eased, and therefore you are actually seeing better travel numbers. In fact, Q1 in China was a record high. But yeah, a lot of routes are now being added between China and Europe and US and rest of Asia. So that's going to be the key thing that drives global jet demand higher.
I just want to come back to the first answer that you said, that while there is lots happening, but we haven't really seen an impact on supplies. Would you say the same for Red Sea? And do you believe that the geopolitics, even as they continue to simmer on the side, wouldn't really impact so much as supplies?
Look, geopolitical tensions remain high, but equally none of them are really materializing in supply losses. The only one that is actually a potential threat to supply, and probably the biggest threat this year, is Ukraine-Russia. Ukraine has been launching attacks on Russian infrastructure and particularly refineries. Could they expand that to other infrastructure like ports and so on if they don't get the funding? And if that's the case, then there could be a lot of upside to both, oil products prices and crude oil prices. The Red Sea is more of a supply disruption. Sorry, it's not supply loss, but trade flow disruption, right? Now you just have to go around the Cape to reach Europe. So it increases the cost. It's inflationary, but it's not a supply loss. I think that's the difference between the two. And we expect that to continue.
All right. Amrita, final question. This is about macros, really, because there's a conversation about rate cuts and there's a lot of currency movement as well, with dollar index at a 5-month highs, and every other currency, whether it's Asia or the high-yielding currencies, have been trading at multi-month lows. What do you see an impact of all of that on global commodities?
Yeah, I think there is a bit of optimism around global demand, and that's because of these expectations of rate cuts. Our view also is that the Fed's going to cut rates, but I would just warn that if oil prices were to spike higher and this, inflation concerns come back, I think it'll be a lot harder for the Fed to cut 3 times as the market expects.
All right, Amrita, thank you so much for joining us. So, well, 90 to 95 and 100 not ruled out in case something really flares up there, but that's really not the best case scenario here. That's a wrap on Bazaar with all that conversation, but Chartbusters is coming up next. Stay tuned.